let's get your thoughts on the outlook for equities. I mean, everyone has talked a bit about the drag that the banking sector has been on the equity market, but we seem to be getting past that with the recapitalization of the banks. Now we have new issues. We have obviously how the fixed income side of the market is playing, and yields going to as high as 20%, even for close to 20% for treasury bills. No incentive for many investors to come into equities. How tough is this going to be for the equity market in the short term, in your view?
I think it's going to get tougher. The interesting thing is that before the central banks moved last week, we generally thought that we had seen the worst for the equity market because it just looked like the tide was turning. But when you think about it and look at the dynamics against the market today, it looks like the odds are just perfectly stacked against the equity market. Yields, as you mentioned, in the money markets have just gone through the roof. Now, for investors who've been looking for upside, the money markets provides perhaps a safer bet right now. If you also look at the fact that for some of the numbers that have been coming out, even though we've seen some underlying growth in some top line numbers and probably in some cases bottom line numbers, there still seems to be the question, the overhang on the economy, that there's so many impending economic movements that are going to happen, and everyone is saying we can't exactly model what the impact of those things would be on the economy. I mean, the central bank, I believe, is fighting a losing battle on the currency side. You probably will see some stability in the currency market for the next month or two. But if the dynamics of the market continue the way they are, we still spend billions of dollars importing petrol, which means that the demand for FX isn't going to disappear. As long as people drive their cars, there's always going to be that significant chunk of cash going. The market is also more open today, so foreign investors who easily could bring in their cash can also take it out with the same level of ease. So I think that those dynamics that just tells you that, look, from a currency point of view, the central bank is fighting almost a losing battle. Now, from the fiscal point of view, we've all sung the fiscal song, everyone is tired of it. Federal government is just spending like there's no tomorrow. And we're saying, look, it's not sustainable because in the long term, you're jeopardizing the strength of the economy. Now, equities is just like the whipping boy in all of this, because once investors panic and the outlook is unclear, then what naturally happens is portfolio managers allocate their portfolios away from equities, more into cash and fixed income. And that's exactly what we're seeing playing out in the equities market.
If we do go into the equity market, obviously, the equity market is a risky place to be, but it's for long-term investors. So banks versus non-banks right now. Obviously, we know that investments have been skewed largely towards the non-banks up till recently. What are your thoughts going forward now? Is this a time to be heavy in banks?
Absolutely. I actually think it's a time for people to start to look at their portfolios and say, look, you know what? There are certain banks that have been beaten like there's no tomorrow. And if you look at valuations, you see that valuations are really very cheap right now. Now, for long-term investors, I think that this is a time when you need to start looking at your portfolio again and saying maybe if you had bought UBA, say at 8 Naira, it's been marked down for bonuses, but UBA is hovering between 3 Naira and 4 Naira right now. It's probably an opportunity for you to average down your cost and look to the long term. Now, we've always sang the song that, look, equities is not for short-term players. And the reason why we had the problems we've had since 2008 anyways is because people who had no business practically being in the equities market found themselves in it, and confidence has been destroyed, if not completely. I mean, has been completely destroyed. So the key issue here now is if you're a long-term investor, there's actually no better time to go back into the market than now, because if you're saying 5-6 years down the line, banks like GTB, banks like UBA, First Bank, Eco Banks of this world, those guys would have turned the corner. I think that the monetary policies that we're seeing today also means that banks become less risk takers than they've always been, which is very good for the market. Yes, they don't book loans as aggressively as they were booking it before, but you can actually be sure that the quality of loans that they're booking in their books is significantly better than what they had 2-3 years ago. And I think that over time, that is going to filter down through their numbers, and it's got to be positive for them. Now, for the non-banks, the flip is the case, because now, if you are borrowing borrowing as a corporate at 11%, your chances of being able to borrow at 13% today is almost impossible. So we've seen bond yields rise, which means that even for corporates, your access to credit suddenly becomes more difficult. So it's obvious that we might see some level of pressure on the corporates.
So overall, the banks are
I think the banks are looking good right now.
I agree with you. Thanks so much for giving us your thoughts. We're speaking to Femi Oladehin from Argentil Capital, giving us his thoughts on the Nigerian market, and of course, he's making the play for the banks right now.